We're going to continue here at the Canaccord Growth Conference. I'm Joe Vaffey, Equity Research Analyst here, focused on FinTech. And we are pleased to have with us the management team from Repay, and in particular, John Morris, the CEO of the company. Repay provides integrated payment processing solutions across a lot of what we would call some of the faster currents in electronic payments, both in consumer and B2B payments. The company just reported its Q2 results, showing some solid progress in re-accelerating the business. And so we'll talk a little bit about our Q2 results. And so with that, welcome, John.
Thank you, Joe.
All right.
Great to be here.
Yeah, so maybe we'll just start at a high level. Maybe just for those that may not know your story, just introduce Repay to us in your own words real quickly.
Sounds good. And great intro there on that a little bit as well. So good morning, everyone. Thank you for your time this morning. So Repay, we're an integrated payment technology company. We integrate into the various different software platforms that manage the workflows of our specific clients. And we have about 286 of those different software integrations. We embed our technology in there that help them move the money to pay or get paid. Specifically, about 80% of our company surrounds consumer bill pay, where we're allowing that particular vertical software provider and client to integrate that and get paid on a particular consumer invoice. Those invoices particularly could be around an automotive loan, they could be around a credit card receivable, they could be around a mortgage payment, they could be around a personal loan, even a buy now, pay later concept. So a revenue stream that's tied to that. And then on the business payment side, it's about 20% of our business. We are integrated in various different accounting ERP systems that actually drive what we call bill pay for businesses. So we have two sides of that business, where it's accounts payable, which is a very large go-get market there, where we're helping our clients execute on paying their payables. And we have a total pay solution there. So we allow them to pay and get paid. We pay all their invoices, it'll be with a virtual card or with an ACH or even with a check. We allow them to execute on their payables, and we help them execute on that. We help them move the money. We own our own technology stack. We own our own gateways. We own our own clearing and settlement engines. We clear and settle with the various different networks. We have an omni-channel approach on the consumer payment side as well. And then on the business payment side, we actually have an omni-modality piece of that. We integrate and embed into these various platforms. That's kind of really our value add and our moat. We fully embed into that solution, so it's easy, takes the friction out of the payment process of that. We help them reconcile it back into their core systems.
That's great. There's been a lot that's gone on in payments over the last few years. People are adopting the technology, but it does feel like still some of that B2B payments volume is still not electronic, right? And so it's fair to say that, B2B is still a smaller part of your business, but it's a faster growing part of your business?
It is, yes. So two sides of that. So there's the AR side, and then there's the AP side. And we mentioned just recently on our call where we're investing, putting even more attention to the AP side of that piece. So we think that there's just a giant go-get part of that. And we're vertically focused there, as you know, automotive, healthcare, hospitality, property management, even nonprofits, education, municipalities there. We like that vertical focus there because it allows us to really build our vendor network. We have about 440,000 vendors now in our network. And as we add a net new, obviously our ability to gain synergies off that is great. But the go-get there, we still, obviously we don't report total payment volume, TPV, but what we're seeing is a really growth in our TPV, which you've heard us talk about our ability to monetize that. So we really think we're great at helping our clients execute on that. The total pay value proposition in itself has value, right? Because we're going to help automate, we're going to help execute on something that has to be paid. And then the fraud part of that what we've seen is and we mentioned this on our call, the fraud part of that, the ability with the cyber world really increasing the fraud piece of this piece, our ability to actually offer the fraud protection around making sure payables are properly executed, making sure it's secure. So we see great value proposition in that piece as well. But the go-get is, we think it's really there. It's, if you think about, we call it the second frontier of payables.
Yep.
The first frontier if you think about that as, I would call that payroll.
Okay, sure.
And if you think about payroll today, it's almost always, it's all outsourced and automated in a lot of ways today. This is the kind of the second frontier, and we still see tons of checks. Our net new clients are still, we're really bringing people into this piece of it. And the business back office is going to automate. Mm-hmm. It has to.
Sure, absolutely. And it might be just interesting for people in the audience to know, part of business payables is that vendor network, right? And how does a company like Repay get 440,000 vendors on your platform?
As you can see, we were in this time last year, probably 330 or so. So that's the growth on a net new basis. Kind of our secret sauce is what we do on vendor enablement. We don't just go and say, hey, we only want to process for your clients that'll take virtual card. We say, give us all of your payables, and we will help you execute on all of that. And fundamentally, we will pay every one of those, and you can track and trace every payable invoice through its payment life cycle. Treasury management today, and most companies cannot do that.
Yep.
It's just a pay, and if you think about a check is paid until it doesn't get cleared. Mm-hmm. Or it doesn't, so we give them full visibility, and on that piece of it, that in itself is a great value proposition to that. But as we push on that vendor network, we're adding net new every month. Mm-hmm. There is a great synergy to that.
And there's a network effect.
There's a network effect.
Some of those vendors could then turn around and hire Repay for their own payables, right?
Yes.
And then that cycle continues.
Every payable client is a potential client.
Right, exactly. And slightly switching gears, you went through a strategic review. Was it early this year or late last year?
Yes, early this year.
Early this year. Came out of the strategic review with I think a sharpened pencil on your go-to-market strategy. I think that Repay's got a great platform that could be bigger. I mean, you've got your own processing back end. You've got a B2B business that's growing. You have a big consumer business, some of which is with large enterprises. So I think your TAM is pretty big, but maybe share with people and I think you hired a strategic consulting firm to help you.
That's correct.
Kind of look from the outside in a little bit. And so, what were some of the things that came out of that?
Yeah, so great point. So we used a very reputable third-party firm. I've been in payments since '97. So I always think it's important to check yourself and see. I see the opportunity there, and it's really great. But I wanted to validate some of that with a fantastic firm that has those specific individuals had some fantastic insight and knowledge. Yeah. Because of some other relationships and things they have done, and we came out of that knowing that the opportunity absolutely is there. Mm-hmm. And we pinpointed those additional incremental investments that we should be making that we could really do. Kind of our story right now is sequential reacceleration. We want to return back to growth. Mm-hmm. In the history of Repay, we've never had a negative reported growth quarter in the history of Repay. Unfortunate for that, but so we're making those. We're pinpointing on those. Some of those specifically is around our go-to-market, is around optimizing our sales force, adding additional resources on the sales support side, adding some additional resources, what we call SDRs, mm-hmm. Engagement activities on our client side, so we can do upsells. This overall investing in some of our product and pipeline solutions, specifically as well. We're investing in how do we drive more out faster through our implementation pipeline.
Got it. And so I always wanted to ask, and I've actually never asked how, since you have your own processor, you've got maybe a cost advantage versus others in the market. If you could maybe kind of drill down on that idea a little bit and some comments.
So most people may not realize that we own our own clearing and settlement engine. Very few people actually do. There's a handful of the bigger processors that do. Most everybody else uses one of them. And so we actually have that strength of ours. So where I say with that, Joe, is if we want to win, we can win.
Okay.
Now, we like to be profitable winning.
Sure.
So that gives us the ability to do that. And some of our direct competitors, they don't always have that full suite of solutions where we truly clear and settle with all the networks. So we understand the cost side. We understand interchange. We understand all the banking costs that go into how you move money out there. We also think that drives a high-quality solution from a customer service perspective. You don't get lost in the never, never land. We understand that land.
Right.
So competitive advantage for us. I think and we've touched on this before, is with all the consolidation happening, we're actually seeing opportunities arise because as consolidation happens, disruption happens to people who are processing with other people.
Sure, absolutely. And would you say that there's more of an advantage on the consumer or the B2B side, given your kind of full stack?
The full stack piece of that, we actually have, I say advantages on both. On the consumer side, they're a little bit different. We definitely, on the disruption side, the consumer side is definitely there. On the B2B side, because of our full stack piece, our ability to embed with the enterprise software partners is substantial. We're adding those enterprise plays specifically on the payable side. And even on the enterprise software side, we can do the payables and the receivables as fully an integrated play. So we see our ability to really execute on that, kind of a multi-year process. Those software partners, those enterprise software partners, they can see the volume of payables there.
Yeah.
And those are big numbers.
Right.
Now, our ability to help them execute and monetize that is our goal.
Sure, that's great. Maybe we switch gears a little bit and kind of talk about some of the numbers you just recently reported, your Q2.
Q2.
Right, so maybe kind of some of the key takeaways from the quarter, just in terms of revenue, profitability, free cash flow.
Yes. So our revenue was up. So again, we're sequentially, our thought pattern here is obviously sequential quarterly growth, re-accelerating back to our high single-digit, low double-digit growth. We were able to do that in the second quarter. We sequentially grew from the previous quarter, and gross profit is our metric for overall growth. And then specifically, and we call it normalized gross profit because we have a political media piece that comes every other year. Yes, last year was obviously a big political media year in a really good way for us. And so that was true. We returned, so our free cash flow was 71%. A little bit of working capital in that, so that's a little bit higher than normal. And then ultimately our goal was to return back to 60+% as we exit the year as well. So we're executing on that sequential growth piece that we talked about. Cash flow, we've been profitable. Obviously, we've been profitable for a long time, way before we were public. Our margins in Q2 were 42%.
On an EBITDA basis. Adjusted EBITDA, right? Yeah.
Adjusted EBITDA basis, 42%. Cash flow generation is there. We ended the quarter about $160+ million in cash on the balance sheet. We bought back year to date, we bought back $38 million in stock.
Okay.
So 7 to 8% of the company since the last quarter, since May.
Right. That's great. Yeah, kind of rule of 40 with just on the margin side alone almost. So what about, I know there's a convert that is coming due in 26. I mean, you've got a lot of cash, good cash flow. Refinance that or pay it down, or what's the idea?
Yeah, great question. We talked about this on our investor call. Specifically, we have $220 million in convert coming due in February of 26. That's at 0%. So we kind of like the rate on that, considering we're also making money on our cash today.
Sure.
So we would look to ride that out unless we can opportunistically buy some of that.
Yeah.
That would, cost benefit there. Specifically, we have cash. We'd like to retire some portion of that with as much cash as we wanted to use on our balance sheet at that time. And then the remainder, we have a $220 million revolver, so we could just pay it off with our revolver today if we wanted to. But we would look to retire a good slug of that with cash, and then the remainder with our revolver.
Got it. And once we get, that's next year, right?
February next year.
Right, so it's, after we get to that point, do you think capital allocation changes? I know you've historically done M&A, and I know, in some of our recent discussions, pricing in the private market wasn't like super rational, at least for your, for your taste. So, how's that, you did a lot of inorganic growth and built a big business, and so you kind of know how to do that. Would you think about capital allocation back to M&A a little bit more?
Yeah, we have the ability and the horsepower
To do it now,
platform,
right? Yeah.
because we own our own most parts of that,
Yeah.
and we've proven our ability to get synergies out of that. I think the biggest reason for it is, if you want to look at, we don't buy things for the sake of buying
Yeah.
them, and as my shareholder, our discipline of capital allocation there. We've seen a lot of things. We look at a lot of things. We get invited to see a lot of things. I do believe there's some really great assets out there. We think it could be multiple times bigger than we are.
Yeah.
And inorganically is going to be part of that formula. But you can see we've been disciplined with that. I do think there's some unique assets strategically that are going to come to market that could be very interesting for us, that would be in our swim lanes, allow us to drive scale. So we will be paying attention to that piece of it. But net capital allocation, as is just told investors, is we obviously organic growth is the top of the list.
Yep.
We think incrementally we're making those investments. They're not large numbers in general, and we're going to continue to execute well on those, adding enterprise sales, driving that additional piece. The second one is the convert. It's right in front of us. We will absolutely address that. The third one would be, obviously, we're managing our CapEx as part of cash flow. And then the third one would be opportunistically, if the market continues to decouple us from our intrinsic value, we think we're
buying some of that in.
We're important from that perspective. But we do think there's some tuck-in M&A opportunities out there that would be very attractive to us.
And would that be, give us a hint, would that be B2B or consumer?
It could be either side, but we do see some opportunities coming in the B2B world.
Yeah.
It's not specifically to us, just potentially coming to the market.
Right. Fair enough. So it sounds like you may have your eye on a few particular assets that might be nice fits for you. Good. That's great. I know you announced a new CFO recently.
Yes.
So maybe we kind of talk about Mr. Rob Hauser a little bit.
Yes.
Yeah.
So Rob will be joining us on September 8th. Rob Hauser, you can see his press release. He's got a tremendous amount of history in the payment space overall, and I'm really excited to have him on board as a partner for us and what we can partner together. We think that his knowledge in the overall bill payment space, we think there's a fantastic opportunity for us to join hands together. He's excited to join us as well, and we're looking forward to introducing him to you.
That's great. Now I want to circle back around to the Q2 results, because I think you talked about some sequential acceleration in the business. Maybe we drill down on that sequential acceleration and kind of define where it came from, new logos, higher volumes with existings, seasonality, what those things might have been.
Yeah, so it's kind of step back a little. We were coming out of the first quarter, we had negative growth. Specifically, for those of you who may not know this, we had a couple large client losses, and that's a large part of that. Specifically, in the first quarter, it was about 8 points of growth that cost us. So we got to lap that. So some portion of this is obviously the lapping of those things, just to be upfront about that part. That was about 5 points in the second quarter, and then the political media piece of that. If you normalize these particular things, political media is about 1 point.
Yep.
So that gets us back to positive sequential growth. We want to continue to add to that in the third quarter, which we think we will. And then fourth quarter, we'll have lapped most of those client losses.
Right.
And on a normalized basis, that's where we think we'll get back to the high single digit, low double digit.
Right. And I think for everyone's benefit, wasn't there some M&A or something, or was there some of the client losses? Was that?
Yeah, we had two large clients for us, been with us a long time. Two were purchased. Many times we benefit from that, but in this particular case, we had a client that was purchased that actually did their own processing.
Right.
So we really can't do processing for free. So
Sure.
We would have done the same thing if we were on the opposite side. And then we had a client that got purchased and had 10, 15-year relationship with the larger relationship piece of that. So difficult for us to win that. We do win many times, though. Many of because we're vertically focused, we generally have some of the larger clients, and we're generally our winner in that.
Right. That's right. Maybe we talk about a couple of the emerging areas. I mean, auto is having its ups and downs, but you have signed some big logos in auto, and I think you disclosed Mercedes.
Mercedes, yes.
How does that pipeline look? And then maybe we'll touch on some other markets.
Yeah, so from a year-to-date perspective, we've had very positive bookings. That's the health of your pipeline coming into that. Our pipeline's as healthy as we've seen them, which is very positive. And bookings are as good as we've seen.
Okay.
So those are all obviously very positive indicators for if I'm talking about accelerating growth.
Yeah.
And so ultimately those will have to flow, bookings will have to flow through implementations, which is why we're investing in implementations to drive that through. And then, so on a logo perspective, we're seeing it on both sides of the business. The payable side of the B2B side of our world. We've had some really nice hospital wins. Again, the back office is automating.
Right.
So things that you probably don't think about, the back office of automotive dealerships is automating. So that's a really positive part for us. On the consumer side, we've started investing more last year in enterprise sales. Those wins are starting to come through. We're investing even more in enterprise sales. So some of the investments we're making right now are 26 outcomes. And so all the indicators look positive for where we're headed into 26. We do think we're setting ourselves up for, a positive growth story for 26.
Right. Yeah, I mean, it sounds like it. I mean, you're going to lap some clients lost, wasn't your fault, and political media spend comes and goes every 2 years. The rest of the business is doing pretty well, and you're also investing in growth.
So. We're investing in growth.
Right.
We have a strong balance sheet.
Yeah.
We have cash. We've been profitable. So we think we're in a really good spot. Obviously, desire to grow faster, and we think we're making the right investments to do that.
Right. I always ask you this question, John, but one of the areas of broader electronic payments that's not super electronic today or isn't card friendly is mortgage payments, right? I mean, it makes sense, right? Because the lenders don't want to pay 2% on a mortgage that's 3.5%, right? I mean, they can't make money. But I believe some of the large card networks are waking up and smelling the coffee and thinking about different interchange rates to open that market up, right? And I know you've been involved in that, and so maybe at a high level it'd be interesting to see where progress is being made there and how you might participate over the medium term.
Yeah.
Right?
I think that's a great question. And so we've talked about this before. So on our consumer bill pay side, that's predominantly all debit or ACH types of payments. There's really no credit.
Yeah.
Occasionally you have some credit and some couple things, but it's predominantly a debit transaction when it's in itself is the cheapest card payment. And then we are in what we consider to be emerging markets. When you talk to the card brands, if you go look at Visa, MasterCard's, some of their investor relations information, you'll see what they call new payment flows. So if you ask them where's organic growth going to come from them in the U.S., it's where if you look at our business, it's where a lot of those things are coming from. It's going to come from the consumer debt repayment type transactions like mortgage, where they realize that they're not touching that world. They don't really, it's a very broad, large volume world that very little is done from that perspective. we're partnering with them to do a lot of different things in these emerging markets, both on the consumer and the business payment side. We're going to use that to drive, to the extent possible. We have to make it cost effective to be able to get people to use those different modalities. And they're partnering with us to help drive that acceptance. So we're excited about some things we're going to be able to do there. It's a slow-moving market. Sure. But the one thing we know is the consumer actually wants to be able to pay the way they want to pay.
Yeah.
It's got to be cost effective. We think we can address that.
Yeah, it's a lot of payment volume that's still greenfield-like a little bit.
Yes.
Yeah.
So if you think about it, and people talk about maybe RTP or FedNow, and as a real-time transaction, or many of you may use, Zelle or some type of, Venmo or something that may be more real-time for you. A debit card is instant, real-time, 24/7, and it's been around a long time. It's very effective. Probably the only thing the business side of it doesn't like is maybe the costs. So the consumer side loves it. Most of them have that number memorized. Most of the time, all the other wallets are driven off of that. So we think there's an opportunity for us to address this large go-get on the consumer side of that specifically.
Very good. I think we're out of time, John, but thanks for being with us. And look for Repay, some nice acceleration coming, hopefully, at an attractive valuation.